you go into investing, I think here, first thing first, FTF, before you start investing, you must understand your risk appetite. You must understand your risk tolerance. And so investing itself is a big risk. So if you are going to invest, you must understand what your risk tolerance is. And here we define risk tolerance as that investor's ability and willingness to lose some or all of an investment in exchange for greater potential return. So your risk appetite or tolerance depends on your ability to, or your willingness to lose some or all of your investment in exchange for greater return. Now think about it. 2020, when the pandemic started, when the pandemic started, the global stock market went down within a couple of hours by 20%. And you can see it on the trend line that this has dipped by 20%. Now, the question I want to ask you, which you can put in the chat, is that if you have an investment that has gone down by 20%, what would you do? Okay, come back here. So if you have an investment or your portfolio, say you have £1,000 in your portfolio, and then it went down by 20%, 1,000 overnight becomes 800. Now, can you tell us? We have about 34 people here in the chat. Tell us, what would you do? Will you sell everything because you don't want it to go down more? Or will you do nothing, just observe? Or C, will you buy more? Just be honest with yourself and just tell us in the chat, and that will also inform our discussion. So someone is saying buy more, someone is saying A, sell everything because they don't want you to go down the more. Of course, 20% is one. It can also go down by 100% or even 80%. So there is that risk there. Okay, so can you put that in the chat? Okay, someone says do nothing. Someone buy the dip. Okay, buy more. Someone says sell everything. Okay. All right, let's keep it coming. Sell some. Okay. Someone says observe for a while. I believe that is do nothing. Okay, someone is saying that has happened to them before. Okay, that's very good. Again, we have a few responses, but I would really like to get a lot of more response so we can really see what is really happening. Okay, someone is saying that we look at the market trend and depending, sell or do nothing. Okay, that's very interesting. And again, from the response that we have given, we can really see what your risk appetite really is. Someone is saying, okay, we observe, which is also another possible option. Sell some. Okay, someone is saying they will do nothing. Again, you can see, as we are about 34 of us here, our risk tolerance is so different. Okay, we are so different in our risk tolerance. So there are different things you can do, but at the end of this meeting, I'm going to send us, as part of the follow-up resources, I'm going to send you a link where you can answer about 5 questions, and at the end it will tell you what your risk tolerance is, and that can also help to inform how you invest outside this meeting. Okay, so thank you to everyone who responded to that in the chat. That's very helpful. Okay, so I want to go back a little bit. So in terms of your risk appetite now, like we said, your risk tolerance determines what you invest in. So if you are someone that says, oh, you will sell everything, then you are most likely going to be a conservative person. Now, if you are someone that says, okay, I will do nothing, I will observe, you are most likely a moderate person. Now, if you are someone that says you're going to buy more, then you are most likely a very aggressive investor. Now, what does that mean? If you look at the chart that I can see on the screen, I hope you can all see that. You can see on the x-axis, that is on the bottom axis, somewhere around here, it says expected annual volatility. So volatility increases as your tolerance increases as well. So if you have a very high risk appetite or risk tolerance, that is, if you are just responded in the chat that you're going to buy more, you are most likely an aggressive investor. And what that means is, for someone like that, they expect more volatility or a higher volatility in terms of percentage. And those people tends to have higher return at the end of the day. So the y-axis here shows you your amount of return. So for someone who says, oh, they will sell everything, they are most likely a conservative investor, and the what you get at the end of the day can be lower compared to someone who is very aggressive in their investing. So again, it doesn't mean that one is right or the other one is wrong. You just need to know yourself and then strike a balance between where you are and where you are going. And in our last webinar, we talked about, setting goals, how to win in the new year. And one of the things we emphasize is the importance of having financial goals. So if you missed that, please go back on YouTube and to watch that as well. So knowing where you are, just begin to imagine and just settle that within you. Where do you fit on this chart? And from there, we can begin to have a further conversation. Now, if you do decide that you are, for example, an aggressive investor, where if there is a reduction in the value of your portfolio, you tend to buy more, then most people like that tend to invest more in equity. Okay, that is, they invest in the stock market, because stock market is, it can go up very quickly, it can come down very quickly, but then the reality of it is, over time, you get some positive return by investing in the stock market. Now, for someone who also is moderate in between, they can have a blend of equity and bonds. That is, bond is where the government gives you, okay, you are holding the debt of the government, for example. It means that you can get some guaranteed, your principal is guaranteed, and you get some fixed interest at the end. But then you can blend that with a bit of equity, so that your portfolio becomes moderate. You get a higher return than someone who, for example, says, oh, they are very conservative. Most times, those people have 80% of bond, 20% of equities, for example. So in that kind of case, their portfolio is a little bit stable over time, but the increase, that is the appreciation, is always smaller compared to someone who is investing 100% of their money in equities, for example. And so, for example, if you look at on the screen now, you can see here we have a chart that shows you the performance of a portfolio. For example, if you invest £1 in 1900, that's going back as far as 1900. I was in heaven then, I wasn't born then. 1900, going back to 1900, if you go back, if you invested £1 then, as at 2020, that £1 that you invest, if you invest everything in this equity, that is, you invest in the stock market, buying stocks and shares of company, then if you assume that every year there is a 5% growth, it means that £1 that was invested in 1900 will become around £386 in 2020. Now, for someone who decides to hold government debt, bond, for example, that is assumed to be growing up at 1.1%. By 2020, that £1 is now worth around £4 after that number of years. Now, for someone who holds that money in cash, they decide to do nothing with inflation and everything, that £1 in 2020 will be worth around £2. Okay, and here is assuming that the cash returns about 0.6% on a yearly basis. So you can see the difference between someone who invested the money in equities, someone who bought bonds, and someone who kept their money in the bank account as cash. So if you really want to grow your wealth and invest for the long term, then most people tend to go into equity. Okay, so that shows you just what we are saying, that investing in the stock market, equities, bonds, tend to have a greater performance compared to others. Now, of course, some people will say, how about real estate? How about commodities? I think the key thing that you need to focus on is, as an individual, which I will come to shortly, is ease of sales. If you have a house and you need to sell that house, how long will it take you to sell it? For example, if you have a share in a company, you can even decide that on Monday morning I want to sell it. You can sell it within 5 seconds or 5 minutes, depending on the kind of investment, and you get your money back. But if you have a house and you want to sell it, you might need to wait a couple of weeks before someone buys, before it goes through the land registry, and before you can say, yes, I now have money in the bank. So for most people, liquidity becomes very important as to what they hold, because of when they might need the money. Okay, so that's something you need to begin to think about as well. So I've mentioned this briefly. You have different risk appetite, but the question is, what determines your risk appetite? Okay, what determines your risk appetite? Can someone, if you can, just post that in the chat. For you, that says, for example, you will buy more. For you, that says you will sell everything, or you will do nothing. What really determines what your response? Just think about it. There's no correct, wrong, or right answer. Just what makes you think that the best thing you should do is to sell? What makes you think that the best thing you should do is to buy? What makes you think that the best thing you can do is to do nothing? So just if we get a few responses, then we can discuss that. Okay, someone is saying the level of capital available. Okay. Okay, the other one is your financial goal, financial capacity, amount willing to lose. Yes, that's true. So if you have a goal, and the goal is, for example, you want to buy a house and you are looking to buy your house next week, for example, of course, we always say any money that you need shortly, don't put it in the stock market. But if you then happen to do that and you forget the money there, and you can see that things are going down, but you need to have 20,000 to pay for your house. So at that point in time, in order not to risk it, you can pull the money out. So your personal situation can also determine, yes, what you do. Okay. Okay. Someone is saying time horizon. Next person is saying past investment. Someone is saying my sanity, which is very important. Your mental well-being is also very important. Okay. Can you sleep if things go down? Or you are the type that wake up every night to check, oh, how much is my portfolio worth now? If it's going down, you are losing sleep, your blood pressure is rising. Again, those things becomes very important. All right, thank you so much. Yeah, someone else is saying, oh, there are future predictions or circumstances surrounding the drop. Okay, somebody else is saying their past experience. Again, we have all spoken right, and to be honest with you, there is no one size fit all. There is no right or wrong answer. That is why investment is personal. It's very personal, and that's why we are trying to balance the bill for different people, such that you can pick something from this session or from this video. So two things that we write here. There is a third one which I don't have on the note. Is that your liquidity, that is your cash need. Will you need that money anytime soon? That determines your risk appetite. So, for example, if it's the money that you will need, like the example I gave, you want to buy a house, for example, you have saved up £20,000 through sweat and blood, and then all of a sudden you woke up, that £20,000 is now worth 19,500. Okay, and like someone says, future prediction circumstances, and maybe that future prediction is something like COVID, and the thing is still going down, or there is a recession, and you are thinking, oh, if it continues like this, you might not get your money back. In that instance, someone might decide that, oh, I need this money to buy my house. Should I leave now, sell everything, and put my money in cash? For some people, they might say, well, it doesn't matter. I have some money somewhere that I can use to balance. So it means that if you're going to go into investing, it is a good idea to have another pot of money somewhere that you can use, so that you won't sell your investment at a loss. So if you have, for example, an emergency fund, and you want to, something happened and you need money, and at that point in time, the stock market has gone down by 5%, you won't have to sell your investment at that point. You can use the other money until things get better. Okay, so it is always a good idea, before you invest, have a set of money somewhere that you can fall back on in case the stock market goes down or your investment becomes illiquid. Then the next thing, like someone also mentioned, is your time horizon. like the person saw my notes ahead. Your time horizon. So what does it mean? Is that, are you willing to put this money away for the next decade, for the next several years? If you're not willing to put that money away for that long period of time, then it also determines your risk appetite. So it's also very important to note. For example, if you are saving for your pension and you are in your 20s, for example, or you are in your early 30s, there's nothing stopping you from going big and going bold. Why? Because you are not going to get that money for the next maybe 30 years. For example, if you assume that you are retiring at age 55, and if at age 55 you start working at age 20, it means you have more than 30 years to grow your wealth. So in that case, you don't really need to worry if it goes down a bit, because you know that time will heal, time will show you that this thing will go better and go up. Okay, so if you have a look at the screen here, this screen shows you an example of risk reward trade-off. So for example, if you put 100% of your money in cash, that is in a best year, that is in a year where inflation is low, all things are good, then maybe you can get maximum of 15% on your cash. That is, for example, if you put in a savings account, you get a savings account paying you 15%, which in fact is a very I doubt it in in this environment at the moment, because again, interest rates are maximum around 5 or 6% because of the Bank of England base rate. But then in a good year, the best year ever, that money can get 15% interest. But then in a year that is average, for example, then you can get maybe 4%. Okay, you can get 4%, and that's what most people will get on their interest on their easy access savings account, for example. And if there is a worse year, then you might get nothing on your investment. For example, some people get nothing on their money, maybe because they left it in their current account, and your current account is not paying you any interest. So it means that it's zero. In fact, if care is not taken, it's going down in value. Now, for someone who has 25% equity, 75% bonds, in a good year, the portfolio can go up by 29%. Then in a year that is average about 8%. In a very bad year, it can go down by minus 14%. Then if you increase that gradually over time to 100%, for example, equity, if you increase it to 100% equity, in a good year, you can get 37% return. In a year that is average, you can get about 13% return. And in a year that is very bad, it can go down by as much as 37%. So you can see that the more equities you have, and in a bad year, the lower the portfolio goes, but in a good year, the higher the returns as well. But then good years are usually exceptional. Most time it will be around the average year. So if you look at the average year, for example, you can see that by increasing the composition of your equity, your investment consistently do very well, across board. So the more equity generally tends to result in better performance. And this again becomes very important. If you have a long time horizon, you have 30 years to work, you have 50 years to work, for example, then you can go long with the expectation that over time it can do better. Now, remember the plot that I showed you previously. When someone invested £1 in 1900, by 2020, £1 in equity is now worth £384. If that same £1 is invested in bonds, it's now worth only £4, in cash £2. So you can begin to see that there is a trade-off between the risk and the reward. So for many people, if you have a long-time horizon, then it is a good idea to weigh it in at first and then rebalance your portfolio as you progress. Again, if you have any question on this, please put that in the chat. Okay, so don't just listen, try to engage, put that in chat, and as you are thinking, feel free to think out loud. You can send us a private message as well so that we can support you again. So another way of visualizing this is to look at the graph that I place here. So if you have your money in cash, the return is lower in percentage, but the volatility is lower as well. But if you, as you go up, you go to UK gilts, which UK gilt is bond. The return is also a little lower, but better than cash. But the volatility is around 9. Now, for many people, if you invest in global equities, for example, then your return is very close to 10% on an annual basis, but then the volatility is just about 12. So you can see the trade-off. What you can, your portfolio will determine, or your risk tolerance will determine what you have in your portfolio. So if you want a high risk portfolio, it means you can get a high reward. But if you don't want a high risk portfolio and you want to get a mid-range reward, then you can check, okay, what is around the range, or the mid-range, and then you can stick there, or you mix it, equity plus bond plus a bit of cash, depending on what you really want. Okay, so there's a balance there, but it takes a bit of thinking about what you want.